Stephen, what do you think about the earnings misses here? I mean, it's not as if we're just looking at poor earnings reports, but analysts haven't been able to keep up with the warnings. Is this all part of the slowdown in the global economy?
Yes, and I think the earnings misses have been fairly broad, actually. But if you look at the economy, I think it's the manufacturing sector that's hurting the most. And any business that's involved in shipping, freight, they've been hurt a lot. The overall economy in the United States, at least, is pretty strong. Europe is just kind of chugging along. And then there's all the uncertainty created around the tariff issues where tweet today, tweet tomorrow. You never know what Donald Trump's going to do or threaten. And that is a hindrance to investment. So I think there are broad-based reasons for feeling more cautious about the earnings outlook, and investors punish companies quite hard when they miss.
What is the problem here? There seems to be a disconnect, though, because when I look at, for example, UK unemployment and earnings growth was great this week. In fact, UK earnings growth is twice what core inflation is. The same is true in the US, where earnings growth is at least 50% more than the core, depending if you look at CPI or PCE. And retail sales have been off the hook. I mean, we're getting ready for a back-to-school season in the U.S. that will be at a record. On the other hand, companies are hoarding cash. They're not investing in plant and equipment. They're even slowing down share buybacks. Why is there this disconnect, Stephen?
So the first thing is, I think the economy, particularly in the United States, and actually here in the UK, the economy is in very good shape. US consumers have got wage rises, as you mentioned. They're confident about their job, their wealth's going up. There's no reason for them not to spend, and spend they have. Corporates have seen a very significant slowdown in earnings, and they've responded with the uncertainty I mentioned earlier by restraining investment. But I don't think there's any recession risk. The other point to note is the stock market is coming off record highs. So the earnings bar was set relatively high last year, and earnings growth has slowed quite significantly. Analysts have taken a bit of time to adjust to that. If you look at domestic US generated profits, they're being squeezed by these higher wage rises. The growth in earnings for US companies has predominantly been from their international operations. So I think there is a number of cross currents for earnings, but I think the fear of recession that was here recently has been overdone. And whilst the data will come up and go down and fluctuate, the broad background for the United States, I think, is very positive. Recession fears are overdone. The big question is whether we get a little bit more inflation, because the market has been powered by this ever lower interest rate yield, particularly on the inflation-protected bonds. And if that starts to retrace, I think that's a much bigger threat, to my mind, for the stock market than earnings. For now, I think it's a positive risk-on environment still, despite the wobbles. But I think if we do get a revival of inflation fears later this year, and people think, OK, the Fed's cut, but it won't cut next year, I think that would produce more of a challenge